Hello everyone, today's vlog is all about property. Should I incorporate my property portfolio? That is the question that thousands of property investors have been asking over the last few years, principally because of the restrictions in the interest relief on mortgages. So HMRC basically aren't big fans of property investors. They actually say in their government budget books, they say we do not like private landlords. We prefer individuals to invest in stocks and shares. That's what they actually say. So they're making life hard for buy-to-let landlords. So since about 2016, there was a change in the rule that said we will restrict the tax relief on interest relief. So when you have a mortgage on buy-to-let properties, the interest element of that mortgage was deductible against tax. So you got tax relief on the interest-only element, not the capital repayment. However, that restriction to restrict the interest has been in for a few years now. It's been staggered, but from the tax year that we're in now, 2020 and 21, the relief kicks in its fullest, which is the curtailment down to 20%. So let's say you're a 40% or a 45% taxpayer and you have property income. Normally, before this change in the rules, you would have had tax relief on the interest expense on the mortgages at 45%. Now that will only be 20%. So a real restriction in tax relief, which tends to be the biggest expense that you can set off against tax anyway. So a lot of property developers are saying, well, look, what if I incorporate my property business? In other words, move all of my residential property portfolio into a limited company. Because limited companies generally pay lower rates of tax than do individuals. So there are many tax benefits of having an income stream, a business in a limited company compared to personal ownership. So the issues around incorporation particularly involve the capital gains tax from moving from individual ownership to moving into a company. Because in effect, what happens is you would sell your property portfolio into a company. Now, even though you may own the shares in the company, and you might think, well, actually, I'm just selling from myself to myself. Technically, you're not. You're selling from yourself into a separate entity, which is a company, even though it may be controlled by you. And that is a capital gains tax event. Now, if you've had a buy-to-let portfolio for many years, you've potentially got massive capital gains, latent gains in that portfolio, which would only come into play if you sold them. Now, selling it to your limited company on incorporation potentially would trigger such a massive tax charge for capital gains tax. So you have to be very careful how you go about doing it. Now, thankfully, there is a relief in the capital gains tax code called incorporation relief, which basically means that when you do turn a business from a sole trader or partnership business into a limited company business, then any capital gain that would have normally been due is rolled over. It's deferred into the cost of the shares, so that actually the gain only comes into play if you sell the shares in the company way down the line. So that is what it's all about on incorporating a property portfolio. Can I claim what's known as incorporation tax relief? Now then, consider the HMRC thoughts around property investing. Yeah, I've just said at the start of this video, they've got it in for property investors, but years before the changes to the interest restriction, HMRC had the mindset that property investment wasn't a trade. It wasn't a business, it was passive income. So the incorporation tax relief that's been around for decades for businesses converting into limited companies, that in HMRC's mind didn't apply to property investors because they didn't have a business, they didn't have a trade, it was passive income. So this was actually tested in the courts about 5 years ago, the so-called Ramsey case. You might have come across it in the press, where Mrs. Ramsey, she had a business, a property business, and it was an HMO. It was actually one property, but 10 separate tenancies. HMO, house of multiple occupation, and there was 10 separate tenancies in this, and she successfully argued in front of the tax tribunal that she was running a business, a genuine trade. It took up many hours of her time every week, and this was not some sort of passive investment. This was a genuine business concern. She was trading, and she should be entitled to this valuable tax break for capital gains tax called incorporation tax relief. And the tribunal agreed with her and disagreed with HMRC. So she got this incorporation relief on the capital gains tax. So the general rule of thumb, if you are a property investor and you're looking to incorporate and claim this incorporation relief, the key is the level of time you're spending on your property portfolio and the number of tenancies that you have. Not necessarily the number of properties in the portfolio, but the number of tenancies. Because like with Mrs. Ramsey, she had one property but multiple tenancies. So the general rule of thumb is about 20 hours a week dealing in your property business and 10 tenancies, a minimum of 10. And if you have those, then you should be able to claim this incorporation relief and roll the gain over so that there's no capital gains tax when you move your properties into a limited company. Now, what if you only have one or two properties and you're not spending 20 hours a week looking after the portfolio? Then that will prove very difficult to get incorporation relief unless you interpose a step in between going from sole ownership to the limited company. And what you would typically do is set up a partnership with spouse, or it can be with anybody, but you set up a partnership and you run that as a business concern for about 3 years, and you become that generates the trading status, as it were, before you can then incorporate. So an extra step that is needed. Now, that will then also qualify for incorporation relief. But coming back to the first one, when you already have a property investment business, multiple properties, and you claim the incorporation relief without being a partnership, so you just go straight from sole ownership to limited company, yes, you're going to save on the capital gains tax, but there is potential stamp duty land tax problem. So SDLT will be payable by the company as the buyer of the properties. So you might have saved a fortune in capital gains tax, but big SDLT. However, when a partnership transfers the properties to a company, one of the rules in the SDLT legislation is that the buyer doesn't pay any SDLT. So actually, even if you would qualify for the incorporation relief straight away and not have to form a partnership for several years to get the capital gains tax, you may nevertheless want to form a partnership to begin with so that you get both the capital gains tax break and the stamp duty land tax break. So sole trader to partnership to limited company, saving on the SDLT and on the capital gains tax. And then once you've got your properties in the limited company, you will be subject to the corporation tax, which is low, it's 19%, and it's certainly a lot more favourable tax treatment than if you'd hold those properties as an individual, coupled with the new rules on the interest relief restrictions. Now, the mechanisms for doing it, practically, there's all sorts of pitfalls involved with this, and you need to take specialist advice before you even consider this, because what technically happens is that the legal ownership remains the same, but the beneficial ownership moves into the company. So any asset, no matter what it is, can be split into two types of ownership: legal ownership and beneficial ownership. And the beneficial ownership is what drives the tax. So you as an individual will still have legal title to the properties and crucially with the mortgage provider. So you still are legally obliged to repay the mortgage as an individual. However, the beneficial ownership goes to the limited company. And the tax follows the beneficial ownership, not the legal ownership. Practically speaking, what that means is that all of the tax savings are in the company as the beneficial owner. But legally, you still have the mortgage in your name. But at some point in the future, the legal title will also pass over to the limited company when it comes to refinancing and remortgaging in the future. Technically, that completion from a legal point of view on the transfer across is a delayed completion. So, but what happens is, if you try to move all of the mortgages into the limited company at the time of doing the incorporation and moving your property portfolio, you'll tend to find that the mortgage lenders may have charges, early redemption charges, or not have as good a deal in the company. And there might be all sorts of commercial reasons why you wouldn't want to change the terms of those outstanding mortgages at the point of moving the properties into the company. So that's not a problem. They can stay legally in your name as an individual, but the source of the repayments is coming from the company because the source of the income is going into the company, i.e. the rents from those properties. So there's a lot of paperwork involved to get that right. So remember, it's splitting the asset, separate legal title and beneficial title. The beneficial ownership is what's in the company. That is what HMRC will tax the beneficial owner, not the legal owner. But as far as the mortgage company is concerned, you are still the legal owner. Now, they should be indifferent really, because they're still getting repaid and they still have the charge on the asset where they can come after the asset. So the consequences of having the limited company will mean, broadly, a lot less tax than if you've held it as an individual. The tricky bit is just how do you get there? And you have to follow these steps to try and claim these valuable tax reliefs to eliminate capital gains tax and stamp duty land tax, potentially by doing a two-stage process where you turn into a partnership for a couple of years before you then turn into a limited company. Now, the rates of tax that apply in the company, like I said, are only 19% on the taxable rental profits. And you don't need to then strip out the remainder of the post-corporation tax profit. You can leave it in the company and acquire more properties or gear up in the company and build a property portfolio. So what if you are a brand new property investor looking to start a buy-to-let portfolio? Well, the advice would be to start it in a limited company. Don't start as a sole trader, then become a partnership, then become a company. Because we know that the end game of a company is best, if you are starting out, get to that end game right away and form a limited company and buy your first property in a limited company. And then all the subsequent properties can go in limited company as well. So other things to think about is if you have an existing property portfolio, like we said, which is not large enough to qualify straight away for these valuable tax breaks, you might want to have a combination of turning it into a partnership for a few years, but at the same time, if you want to buy new properties, set up a limited company and buy them through there. So in other words, you'd have a partnership owning properties and then a separate company owning properties, and then after a while you would merge the partnership into the other company so that you've got everything under one roof. So it's just making sure you do the right things at the right time in the right way to avoid potentially huge tax problems of the move. like I said, the capital gains could be massive. If you've got an investment portfolio that you've had for years, you could be sitting on capital gains of tens, hundreds of thousands of pounds. So you have to do it the right way, and then that will save on the tax. So that is a quick overview of should I incorporate my property portfolio. Yes is the short answer. If you have more than 10 tenancies and you spend more than 20 hours a week doing it, absolutely. Any less than that, consider becoming a partnership first for a few years and then incorporating the business. And if you are a brand new buy-to-let investor, do it in a company from day one. Okay, so if you like this video, please do subscribe, and I will see you soon.